Welcome, everyone. We're so glad to see so many people joining us for our quarterly roundtable discussion today, which is focused on the 2026 economic outlook, which I know is of great interest to everybody joining us. And for those of you who are new to Hong Group, welcome and thank you for joining us. I'm Heather Johnson. I'll be your moderator today. Han Group is a public accounting firm dedicated solely to nonprofits, specializing in accounting and advisory, audit and assurance, tax and technology. And at Han Group, we believe finance doesn't have to be intimidating or inaccessible. Everything we do comes from a people first mindset. Behind every number is a mission, a staff member,
Mm.
a donor, a community. Our specialty is helping nonprofits translate financial complexity into clarity so that you can focus on impact, not just accounting. Although we do like the accounting. As most of you know, this has been a tough year for many of our nonprofits between new legislation, changes in federal funding, and planning in uncertain times. We've had the privilege to bring together leaders from our nonprofit community to discuss emerging topics, shared experiences, and potential solutions. We've talked about revenue diversification, budgeting, scenario planning, the importance of preparing and analyzing financial statements, and how to engage our boards. And we're excited to focus our last roundtable discussion of the year on the 2026 economic outlook, which I know is a topic of great interest to us individually and to our nonprofits that are planning and budgeting while trying to predict donor behavior, cost of goods, and investment activity. We'll follow our normal roundtable format today of inviting our guest speaker to talk and then opening the floor to questions and discussion. Please feel free to use the chat to ask questions, and thanks to those of you that sent questions in advance. With that, I am so excited to introduce our guest speaker, Richard DeChazelle.
Jackie's
Richard
going to the
is,
debate tournament on Saturday.
oh,
He is. Yep. That's
Richard,
great.
I'm sorry, I think
Do
somebody's
they all
speaker's
get to
on.
it? He gets to know.
Lexi,
No,
are
I
you
think we're
able to
still
mute
figuring
people,
it.
please? Okay, thank you. So Richard is William Blair's macroeconomist
Nice.
who is, okay, sorry, I think I was muted. Okay, let's start that over. So I am so excited to introduce our guest speaker, Richard DeChazelle. Richard is William Blair's macroeconomist who has been with William Blair in that capacity since 2001. Prior to this, he held similar roles at UBS Warburg and Payne Webber. Richard has spent the bulk of his career in London, though for the last decade has worked from Madrid, Spain, where William Blair also has offices. His focus is mostly on the US as the center of global finance and economics, and he writes regular commentary on high frequency economic data and thoughts about the stance of monetary and fiscal policy. He also produces an Economics Weekly publication with longer form thought pieces, as well as conducting presentations to many institutional clients and wealth managers, like the one we're about to hear today. And William Blair is a premier global partnership offering investment banking, investment management, and private wealth management services. So with that, it is my pleasure to welcome Richard to our roundtable. Welcome,
Great.
Richard.
Thanks, Heather. I'll just do the rigmarole of seeing if I can bring up these slides. I never quite get the hang of it perfectly, but hopefully you can see them now. Yeah, thumbs up. Okay,
Yes.
Yeah.
let's go with it. And sorry, actually, one thing, Heather, if you can. I'm not very good at manning the chat function for questions. So if you just read out any or interrupt me, please, with any questions, I'd be happy to answer that. Don't think I'm ignoring you.
Will do.
But just to say thank you very much for inviting me to speak, and thanks for that introduction. And again, thanks for the Han Group for that invitation. I guess nonprofits and donors aren't my typical constituents that I would speak to. I would more speak to investment bankers and institutional portfolio managers and wealth managers. But what I've done is I've sort of presented my economic outlook, and then towards the end, I have put together a slide of how I do think that sort of scenarios that I have kind of will impact, say, donors and nonprofits. So hopefully that fills your curiosity there. I guess I'll just start a little brief outline is that I think the outlook for 2026 is actually reasonably good. I think there's quite a lot of sort of doom and gloom out there that U.S. consumer is falling off a cliff and business investment is only being propped up by AI, and that's a bubble that's about to collapse. I actually think that central banks have been globally easing monetary policy, which I think is going to be helpful. I think fiscal policy is turning from, in the US and a number of other countries, from more of a headwind into more of a tailwind in 2026. I think we should see a broadening out of business investment. And I think the consumer, and all of this stuff I'll get into, and I think the consumer is actually holding up pretty well. And I'll explain why. In terms of the negatives, I'm a little bit worried about inflation. I think it's going to be a bit stickier than the consensus currently expects. Definitely financial markets are fully valued, so that always represents a little bit of a risk. And obviously, there's sort of continued risk on the geopolitical front, which we don't know exactly how that is going to play out. But I think just looking back or into this past year, I think if you could sort of boil it down into one word, I think that word was uncertainty. This is a measure of it's an uncertainty index, sort of a measure by Stanford University professors Baker, Bloom, and Davis, who chart across the financial press uses of the word uncertainty. And this year in April, back at the time of the Liberation Day announcement, uncertainty was basically the highest it had ever been since 1900. Little bit skeptical that it was higher than it was during World War I, World War II, or the Great Depression. But I think it sort of highlights that, clearly there was a lot of uncertainty over the past year. And I think why that is or was clearly President Trump coming into office. He really came into office as the great disruptor and chief. And I think he's been pretty good at flooding the zone, really just sort of throwing it all at the wall, his different policies on his agenda, and trying to kind of get everything through. I think he's quite aware that he had Congress with him with a majority in both houses. He knows that he's kind of got 2 years to do that going into next year. We have the midterms coming up in November, when the House is probably going to change. And then I think throwing so much out there at once is very disruptive, very destabilizing to his opponents, the lobby groups or the Democrats or foreign allies or non-allies. It's hard for them to kind of fight back. So what we got was the Doge. That seems to have disappeared, but that certainly was a big concern earlier in the year. We've had very big restrictions on immigration, which are still playing out. We had the One Big Beautiful tax bill. We just had a government shutdown, the longest in American history. And we've had a lot of uncertainty around foreign policy, whether that's Russia, Ukraine, or actually had some policy wins around Iran and Israel Palestine. But obviously, the biggest one has been the tariffs around the Liberation Day and what's happened there. But I think what this uncertainty did in this past year was to act as a headwind, act as an anchor to kind of hold back growth and investment. So I think companies basically just said, we don't know what's going to happen. Let's kind of do nothing. So we sort of moved into this low fire environment. And in terms of CapEx, companies also kind of didn't do much. Let's wait till we see what happens on immigration. Let's wait till we see, whether this big beautiful tax bill gets through. Let's wait until the shutdown gets through. Let's wait until we see what happens on immigration. So that all kind of slowed economic growth. And I think as we move into 2026, that uncertainty starts to diminish. So I think a lot of policymakers going into next year with kind of the midterms, looming in the calendar, they don't want to make any big aggressive decisions. And I think a lot of the sort of shock and awe of the policies that the Trump administration was pushing, that's all kind of behind us. So that's all being thrown at the wall. And now we're in sort of consolidation mode and seeing, the finer details of what's happening there. And that includes tariffs as well. There's an old expression that tariffs are a little bit like Swiss cheese, where it's sort of hard on the outside, and then underneath there are lots of holes in there. And I think that's what we're sort of dealing with now. We got the hard exterior, and we've seen sort of exemptions coming through, pauses and pullbacks. So, that sort of hard stance has kind of diminished. And I think that's going to be helpful for businesses as we move into 2026. In terms of just what that tariff rate is, Yale Budget Labs, they sort of tabulated all of the countries and what their tariffs were and sort of weighted it. They've come up with a tariff rate of 16.8%, which is reasonably high. But if you look at what the actual tariff rate is, so what tariff revenues are relative to total imports, so far it's only about 10-11%. So that's high. It's certainly much higher than we've seen in decades. But I would say that it's still manageable. Remember that tariffs on imports as a share of GDP, or imports as a share of GDP, only account for about 11% of total GDP. So America is actually a relatively closed economy and always has been relative to, say, Canada or Germany, where you're talking about trade being sort of 30-odd% or 40% of GDP. And if you look at what consumers are spending on, it's only about 9% of their total consumption basket that is spent on imports. So that's the share that's going to be most impacted by the tariffs. There will be indirect impacts, but that's a share. So it's not nothing, but I don't think it's sort of the size of a tax. It's a tax on consumption that's about to push the economy into consumption, into any kind of recession. A little bit about where I'd like to go. So I'd like to talk a little bit about the consumer, a little bit about business investment, inflation, the Fed, and then the sort of how that shapes up for donors and for nonprofits. I think the current narrative and this is where I think financial markets and a lot of economists are most downbeat, is on the US consumer. We have a narrative that there's a K-shaped recovery going on, where the top echelons, the top quartiles of the American society are doing very well, and the bottom of the K, the lower income groups are deteriorating quite rapidly. I think that's definitely happening to a certain extent. We are seeing some pain for those bottom income groups from higher inflation predominantly, less so on the employment front. But if we look at actual consumer confidence, which this chart shows, it shows confidence in the present situation. So how do consumers feel today and their expectations? And I think a lot of the deterioration has come from expectations. So what do you expect to happen? You're worried about the impact from tariffs and immigration and all that other stuff coming down the pipeline, but you're actually kind of feeling okay today. It's come down a bit, present situation assessment, but it's still well above that historical average. I would also say
Richard,
that, yeah.
oh, I'm sorry, Richard, we do have a question.
Sure.
So the question is, does do nothing in CapEx mean to keep the status quo or stop any of those growth investments?
I think last year it meant do very little. So just continue to reinvest to keep your capital stock stable, but not investing for real expansion purposes. So if you were going to invest in a new plant or hire a ton of people, you just said no. So I think going into next year, that sentiment changes. I think, we've had the one big beautiful bill. We're a little bit more confident about what's going to happen on the tariff front. So we can now, or companies can now start to make changes going forward. So on investment, particularly.
I'll say
So
we saw that too on our nonprofit side with corporations and foundations because it felt like they really froze with their giving as well. Everybody was just had a wait and see attitude. They just wanted to see what was going to happen.
yeah, exactly. I think that's been a big headwind. I think and hopefully, I think that is changing as we move into next year, as the midterms. I think the sort of pushback of some of the MAGA crowd, like Marjorie Taylor Greene, should not be seen in a vacuum. I think that's significant that some of these policies are viewed as not totally supported by the Republican Party. So what it does is it cuts off the tail risk of some of the more extreme policies, which I think from a corporate investment perspective helps to build a little more certainty into your outlook. But I think, again, just going back to we do have some data problems. We haven't had data because of the shutdown, and some of the data that we are getting is less robust, unfortunately, than it has been in recent years. So even consumer confidence data has tended to run more along party lines. So if you are a Republican, things are pretty good. If you're a Democrat, couldn't be worse. So just suggests, what I'm doing is sort of pushing back a little bit on the narrative that things are horrible for the US consumer. Again, if we listen to what companies are saying, you don't have to read this, but this is just sort of a smattering of quotes I've taken from various companies that have been reporting their earnings recently, from financials, employment companies, consumer discretionary. Most of them are saying that the consumer is pretty resilient, even at that lower bottom part of the K, and they're not seeing a ton of weakness. A bit of softness, but a ton of weakness. Similarly, if we look at real earnings growth, so average hourly earnings after inflation, it's still positive and it's above the historical rate of growth. If we break that up into income quartiles, what we saw was a huge increase during the COVID period for those lower income groups, mainly service workers at restaurants and places like that, who had to be paid a lot of money to go and work in those places with the threat of COVID there. Now they're facing tough competition, tough comparisons, so that pace of growth has slowed. Higher income wage growth is sort of flattish. but what we're again seeing is that even for those lower income groups, it's still positive and it's still above the rate of inflation.
And Richard, we do have another question about the consumer confidence chart. And wanting to know how much of that lack of change post 2008 is folks just getting used to the onslaught of economic pressures one after the next.
So since 2008, so I don't know how where my pointer is, but well, I think we had a huge increase in certainly the present situation since 2007 when you had the collapse of following the global financial crisis. I think what we've seen since COVID has been a continued deterioration in expectations, where I think people are just very worried about debt, where what's driving growth, what is there's just a lot of uncertainty around policy and what kind of policies are driving growth and where we're going from that. So I think that's been the main function there. So just another thing for the U.S. consumer, I think, which is important, is also in terms of fiscal policy, particularly for those lower income consumers, they're going to get a big lift from the One Big Beautiful Bill coming into 2026. So in last year, or this past year, 2025, remember that whilst the One Big Beautiful Bill was in effect, all of those no tax on tips, no tax on overtime, childcare tax credit, all that stuff was collected, and consumers will get refunded on that just in 2026, and then going forward, it's sort of already adjusted on your monthly wage packet. So that is a significant boost to certainly those income groups that collect or are paid by a tip income or overtime. The rough average amount is something like $700. Those consumers typically see that as kind of free money, and that does tend to get spent upfront rather than saved. So in the first half of next year, we should see that boosting consumption. And the other thing that is being talked about right now is this so-called tariff dividend by the Trump administration, who want to issue $2,000 rebate checks for households or individuals with incomes less than $100,000. So I think maybe they saw that they didn't do so well in the recent state and local elections when a lot of the Democrats did much better. And they're thinking, how can we help ourselves, our Republicans moving into the midterms? Let's give out some free money. So these are being proposed. They will have to be passed by Congress, so it's not something that President Trump can just write a check on. And even if they're reduced, which I would imagine they're not going to be $2,000, but even if they're reduced to say $800, that's still a significant amount of money that's coming through. The other thing we're seeing at the top end of that K is a wealth effect starting to take place. So I don't know where my thing is, but I would circle those yellow arrows, which show after the global financial crisis, we didn't see much of a wealth effect. So the wealth effect is basically households see that their unrealized capital gains, they treat them as banked savings in the bank, and they're sort of hard coded in there. So if my asset portfolio has done really well, I can probably run down my actual savings in the bank, buy more and spend more. And typically sort of the estimate is that roughly 3 to 6 cents in every $1 of stock market gains is spent. So that didn't happen after the global financial crisis. I think everyone was so badly burnt from that. But it did happen in the late 1990s, where we're sort of seeing some similarities to today in terms of the stock market rising quite profoundly. So that is a positive impact for growth right now. but it also represents a risk to consumer going forward. So I think there are three main risks for the US consumer going forward. One is certainly that financial markets or the stock market has performed extremely well, and in particular for a tight group of stocks, those magnificent seven. And I think what this chart shows is that households' exposure to the equity market as a share of their total asset wealth has never been higher. So if there was a correction in the equity market, that would be a negative, would have negative repercussions for this for the consumer. The second thing, which hopefully will be resolved in the next few weeks, is that we're waiting for this to find out what happens on the Affordable Care Act extensions to the I think they were called temporary tax credits. So basically, those were redone by the Biden administration in 2021. They expire at the end of this year. And if they are not reinstituted, households with, say, an average $800 per month in healthcare premiums for the Affordable Care Act could see those more than double. So go up to $1,600 or more per month, which would be very significant and have quite a negative impact for households going forward. So this was not agreed during the recent agreement to end the government shutdown. Policymakers agreed to talk about it mid-December. So hopefully that's what they're going to do and come up with some sort of solution. In principle, well, certainly the Democrats want to push that through. The Republicans are saying, we don't want to support the ACA, but we'll just give you some money instead. Something is going to be done, but we need to see that. So that unfortunately does raise a risk. And then the third thing is we are seeing a few layoffs starting to come through. The danger is always momentum builds in layoffs. So more layoffs beget more layoffs. Again, I think up to now, companies have still been sort of low hire, low fire. I also think that we are in a structurally tight labor market. So the pool of available labor is much smaller than it has been in past economic cycles, which I think disincentivizes a sort of big layoff cycle. The big question
And
is,
Richard?
yeah.
Oh, another question. Do you believe the tariff dividend will be another reason that higher level inflation stays around?
Definitely. Yeah, it could be. So I think, and we can talk about that when we talk about inflation, but if you have higher inflation and you're giving consumers $2,000 to spend, so that's your, if higher inflation is what is damaging or hurting these lower income consumers, and you're going to solve that inflation problem by giving them more money to spend, that doesn't really help the inflation problem. So that's one reason why I actually do think the kind of consensus that inflation is going to come down is potentially wrong this time around. So question that we keep hearing is, what about AI? Isn't that going to result in massive job losses? I think what it does. It will generate some friction in the labor market. I think what we're seeing right now, however, is not AI-related layoffs. So even though you might see companies saying they are, I think that's a convenient kind of umbrella to throw everything under. I think what we're actually seeing now is productivity increases that result from what we saw during the COVID. So post-COVID, or during that kind of COVID period, all these companies kind of discovered all our workers have gone home and all this stuff that we have here doesn't really work very well and it's kind of crappy and old. So we got to invest a ton to kind of insulate us a bit from those workers and improve the capital stock, which they have been doing. And I think the productivity benefits from that capital deepening is what we're seeing coming through now rather than sort of AI. And I think on the AI side, as this chart shows from the Census Bureau, adoption rates have only been about 10%. So we're still sort of in this adoption phase or enabling phase, not so much in the adoption phase just yet. And the other thing I would say is that, when was the last time that a recession was caused by a productivity boom? Basically, never. So I think what you could have is some divergence between corporate profits and labor, or you're sort of fighting over the spoils of this innovation growth economy. So who gets it? Is it the owners of capital, the companies and investors, or is it the worker? Who shares in those spoils? And I think what we're seeing a bit of now is the productivity from that COVID stuff seems to be going more to investors rather than being given to workers, although they are sharing it. We are seeing some income growth. But a sort of scenario you could have, and I don't want to get too economic-y, but a scenario you could have is something like Engels' pause, which was in the 1700s, 1790s in Great Britain, where you had sort of an innovation boom. You had companies taking all the rewards from that and not giving much to the workers. It didn't end up in recession, but it ended up in slower growth, slower consumption growth, and more social strife. So that could be a scenario. I think more generally, though, we're still seeing decent balance sheets for consumers. So this chart shows that what we've seen over the last few years in terms of consumer spending has not been debt finance spending, it's been income-led consumption. So consumers haven't been borrowing tons of money to go and spend more as they did in previous cycles, which I think is important because it means that their balance sheets are in good shape. It means that they have resiliency to any economic softening, and it means that they're likely to be more responsive if rates do come down more. And similarly,
Richard?
Yep.
Oh, another question.
Yep.
Do you think other provisions in the One Big Beautiful Bill that will remove many from social services, like work requirements for SNAP, etc., might offset income gains for low-income consumers?
It does. That does have an impact, and that is more back end loaded. So I think a lot of sort of the negatives that do come through, and there are negatives that do come through. I think a lot of them come through either very late in 26 or into 27 and other years. I think what politicians typically like to do is front end load the good stuff, and then hopefully someone sort of takes care of the back end stuff at some point in the future, and I think that's what we've seen here. Quickly though, but on the corporate balance sheets again are in pretty good shape as well. So they have low debt to equity ratios, tight credit spreads, not any big signs of stress. So I think the outlook there is again, we have uncertainty coming down. We have a consumer that's in a pretty good position. The corporate sector is in a pretty good position as well. But where I see sort of the difficulties is really on the inflation side. And I think that is where there is room for disappointment for financial markets and for obviously consumers who are spending that. I think the view is that inflation is coming down from 3% to 2.5% or maybe even lower. I think what I see is that because it's not a bad outlook for consumer spending, again, going back to what you asked earlier about those stimulus checks, that's going to help to keep spending elevated, certainly in the first half of the year, and inflation elevated. And I think inflation is going to be kind of sticky around that 2.5%. You've also got monetary policy that is mildly restrictive, kind of neutral, but globally rates have been coming down, and that sort of acts with a lag. We have quantitative tightening that's finished and quantitative easing that's going to start up soon. Financial conditions more generally are very accommodative, so we don't hear financial market participants, investors complaining that rates are way too high. We have fiscal stimulus we've talked about. We have a structurally tight labor market. So once again, that pool of available labor that we had over the last couple of decades due to echo boomers, baby boomers, globalization, lots of immigration, all that stuff's kind of going away. We've got anti-immigration, less globalization, and boomers kind of moving out. So that pool of available labor becomes much tighter, and that puts more upwards pressure on wages and salaries, which I think is a little bit more inflationary. And then on the AI front, because we're still sort of in that enabling phase, we're still sort of building the structure to enable the adoption of that AI. That's sort of a little bit more inflationary than, in a few more years, we'll have more of a disinflationary impact, presumably, as those adoption rates come through. So I think what this chart is really showing is various measures of inflation where you take out sort of the extreme measures. It's sort of looking at, on the mean measures or sticky measures of inflation. And also this sort of orangey line, which is the New York Fed's multivariate technical term, but just kind of saying, let's look at the stickiest parts of inflation. And it does tend to lead inflation by 6 months. It's kind of reaccelerating a little bit. So it's not showing inflation coming down. It's showing, if anything, sort of flat to a tiny bit higher. And the other thing which I think is important is I think the inflation regime has changed. And I don't want to get too complicated, but what this chart shows is a correlation between stocks and bonds. And what it shows is that correlation tends to be very sticky, but it's not set in stone. It does change over time. And what seems to drive those changes is the inflation regime that we're in. And I think what this chart is showing us is that the inflation regime has shifted from a disinflationary regime where all the risks around inflation were to the downside to maybe more a symmetrical inflation environment where there are upside risks to inflation where there previously weren't before. So I think in that old environment where the stock bond correlation was negative, it was an environment where we were in a world of abundance, where we had a ton of labor and we had a ton of materials or stuff that company needs. We had hyper globalization. So if companies wanted anything, it was sort of in their warehouse the next day. So if demand was ever too strong, the supply would come on board very, very quickly to satiate that demand. And that would sort of cap any upwards pressure on inflation. And I think since COVID, we're in a world where the supply side is now coming back with a vengeance. That labor, as I say, is no longer as plentiful. And the supplies of stuff is kind of getting cut off by deglobalization, anti-immigration, by even climate change, weird and wild weather. It seems to be sort of ice storm is collapsing refineries in Texas, or a boat gets stuck in a canal that's sort of stopping the supply of this stuff, or geopolitics where we're putting up tariffs or having trade wars with other countries. So it becomes difficult to get that stuff. So all of a sudden, if demand is a little bit higher, the supply is not readily available, and you're getting more volatility in that inflation. So I think on average, my point is that inflation is going to be a little bit higher. So we're not moving into the 1970s, But if we were in a world where inflation on average was sort of 1.75%, I think going forward, we're kind of in a world of 2.5% to 3% inflation, but with more volatility around that mean because the supply side is having a bigger impact on that. And I think for you, if you're looking at investments, I think that's a huge change to our investing environment. I think in that old world where there was a negative, I think that meant you could have a very easy 60-40 portfolio because you could have 60% in stocks and 40% in bonds. And that negative correlation meant that if stocks went down, bonds went up, and that would give you portfolio insurance. And the positive correlation is saying if stocks go down, bonds are probably going to go down as well. So bonds are no longer providing you with that portfolio insurance that they were in those previous years. So what does that mean? I think what it means is you need to get that portfolio insurance somewhere else. I think that means that where you get that is diversification. So it doesn't mean bonds are bad. You're still investing in bonds for yield. You're not just investing in bonds for like your auto insurance, just as an insurance policy. So I think it means you should be looking at a wider array of assets, either international assets or equities, maybe not just in that sort of tight group of Mag 7, look across other sectors or areas which you might not have been paying too much attention to before. And that could even mean going down the market cap scale to sort of smaller or mid-cap stocks. And quality stocks have done very, very poorly this year as well. So what does this all mean for the Federal Reserve and on the interest rate side of things? I think if we are seeing more potential upside risks to inflation, I think for the central bank, it means in that old world of that negative correlation, what it meant for the central bank was because there were no upside risks to inflation, they could keep rates lower for longer. So they were more worried about demand collapsing than some sort of big supply shortage or shock. So they could keep, inflation was viewed as kind of a high class problem. And I think in this new world, they can't do that. They have to keep rates sort of more a little bit higher. They can't provide as much forward guidance as we're used to getting from the Federal Reserve. And this is exactly what we're seeing today, when there's a lot of uncertainty about what the Fed's going to do in December, let alone next year. And I think when we do get supply shocks, the Fed normally looks through those, i.e. does nothing if oil prices go up. Say, for example, the Fed will just say, okay, that acts as a tax, we'll do nothing. Now might have to act a little bit more than they do in the past, than they have done in the past. And what I think that means is Fed policy rates becomes a little bit more volatile, and we see a little bit more discord or disunity, is that a word, on the FOMC meeting itself. So given that view, for me, I think market expectations for rate cuts in 2026 and out through 2027 are too high. I think the market is expecting rates to go just a little bit below 3%. I think the Fed is clearly telling us they're going to cut rates again in December next week. I have a feeling that could be Powell's last cut of his career. So he gets replaced in May, and it seems like Kevin Hassett is going to be the new Fed chair. We don't know that for sure, but the Trump administration has said they've got a winner in the contest there, and he seemed to have been the front runner. But I think if that, so there's question marks about how dovish that new Fed chair will be, whether they have to sort of pay for their seat at the table, if you will, by cutting rates. But I think if they do bring down rates further at the short end, the risk is that it pushes up longer term rates. So the Fed has control over the short end of the yield curve, short rates. It has much less control over the long end. So if you're squeezing a balloon, say, those short rates get squeezed kind of below their sort of natural equilibrium. Maybe that puts pressure at the long end to be higher or come down less than you would normally expect. So I think that is a risk that you could expect. Just before I get to this one, actually, I thought it was interesting that when we do talk about, we've been in this sort of world of monetary policy dominance where all we do is watch the central banks and what they're doing. We care less about what policymakers are doing. I think that world is kind of shifting. And unfortunately, we're moving back to maybe a fiscal dominant world where we have to watch what fiscal policymakers are doing. There's sort of, only one policymaker can drive the bus. You can't have Powell and Trump fighting over the steering wheel as the bus driver of the economy. And it looks like maybe the Fed is getting pushed into the passenger seat, and fiscal policymakers are taking the steering wheel. And I think what that does is it puts us sort of in a world of what's called fiscal dominance, and we start to see something, again, not to get too techie, financial repression, where they try and bring yields down. And this is not just a US thing. I mean, I was just reading today's newspaper, and I saw two examples today in today's paper where this is happening. Canada, so very liberal. Mark Carney, former central banker of Canada and of the UK, now Prime Minister of Canada, he is trying to force the Maple 8, so these massive Canadian pension funds, to buy more Canadian assets, hopefully Canadian government debt, to force interest rates to come down. And another example might be Italy. Italy is trying to force its citizens to declare their gold holdings and pay a 12.5% tax on them, sort of to collect revenue. And they're also trying to get the Bank of Italy to declare that those gold reserves are the people's gold, so that could potentially be sold off to pay for lower debts. I mean, that's something we saw in the 1930s with President Roosevelt and the Gold Reserve Act, where American citizens were mandated to sell the majority of their gold, so show up and hand in their gold in exchange for US dollars, which would presumably inflate away. So these are not, these are some of the things we are thinking about, not necessarily in 2026, but longer term direction of where we're going. So how does this—
And Richard, I have to say, I'm so happy to see this chart. We've had a couple questions asking if you can relate this analysis to philanthropy and to the nonprofit balance sheet.
Right. So here I've tried to do that. So again, that's not really my forte, but I've tried to think about, okay, if we have reduced fiscal uncertainty or reduced policy uncertainty, who's that going to be helpful for? Donors and nonprofit. It's helpful for everybody. Both sides kind of increase that improves investment returns more generally. People feel more comfortable in taking risk. What about a reacceleration in growth, which I think we could have as that uncertainty unfolds? Same thing. It hopefully increases profit, increases in investment returns. What about sticky inflation, or inflation that's maybe even moving up a little bit? Less helpful for both, I think. I think it raises costs. I think it reduces your real spending power, and it puts pressure on short rates to rise or fall left. And then short rates being only slightly lower, so again, less than maybe the market is expecting, could be helpful for nonprofits because it could reduce some borrowing costs. Maybe less helpful on the donor side if it reduces income from money market funds or other short-term investments, which typically would help to support donations. And a steeper yield curve, which is what I think we're sort of heading into, that could be less helpful for the nonprofits. It could increase the financing costs of some projects. Could be helpful on the donor side if it increases those longer term investment returns. And typically, a steeper yield curve is also synonymous with more economic optimism. And then last thing, I mean, I'm not an expert on the tax side. That's you guys. But what happens with the One Big Beautiful Bill? I think it's generally it's sort of mixed, but I'd say tilting to not helpful for either side. If you are an itemizer, it's probably helpful. If you are not, I think what it does is it limits the scope for larger donations. So, not super helpful there. So that's kind of the bulk of what I had to say. I could talk about more stuff or take more questions, or what are you thinking?
Yeah, no, I think that was wonderful. And, what you said about uncertainty is really what we've been saying all year too. And that's what we've been seeing on our side is just that, like you said, everybody's just been kind of frozen with this uncertainty for the year. So the fact that you're saying that you see that kind of breaking up in 2026, I think that is, that's a good thing for our nonprofits. I will add for the Big Beautiful Bill, we think that for our nonprofits that have small dollar donors, that new charitable deduction could be helpful. I'd be
Would be
curious
helpful,
to
yeah.
hear from our nonprofits if you're doing anything about donor education right now to let people know that they will have this new incentive. Um, we're concerned on the other side, though, about corporations because now the One Big Beautiful Bill has a corporate floor where they have to reach a certain minimum in deductions in order for it to be deductible. So, we don't know how that'll shape out, but we're concerned that it could stop some corporate donations. So we're definitely encouraging our nonprofits to work with their corporate donors to make sure that that they're in alignment with the great work that the nonprofits are doing, so that the corporations will still support them. I know another question for us too is just for our nonprofits is always with budgeting and just budgeting those costs for the new year. And it sounds like you're saying that inflation will continue to be an issue that people should be factoring into their budgets, correct?
I think so, yeah. I think the market is overly confident that AI is here and it's going to solve our problems. And the labor market is very, very weak, and the Fed's already behind the curve still in cutting rates. And we're going to see a lot more layoffs coming through the pipeline, and that's going to force, drive inflation down. And my view is it doesn't seem so terrible. Again, listening to what companies are saying, they're not really saying we're on the cusp of a major layoff cycle. They're saying we still see a resilient consumer. Again, if that uncertainty sort of diminishes, they might start to invest more, they might start to hire a bit more. So I don't quite see the narrative or the catalyst for a really big decline in rates. I think we're kind of close to the neutral rate. I'd also say that the productivity growth that we're seeing, and again, I don't want to get too technical, it kind of raises the neutral rate for the economy. So it means that the Fed's policy rate is actually closer to being neutral than maybe they believe. So policy is already more accommodative than restrictive.
Wonderful. Well, if we have about 5 minutes, is there anyone that would like to jump in either with a question for Richard or just to share um, your experience and what you're looking at? Don't be shy. One question we did receive in advance, I'm sorry if I'm not sure if this is actually, well, here I'll talk about this one. So one is we had a question about a recommendation for operating reserves as a percentage of total budget. And I don't know, Richard, if you have thoughts on that. I will say that industry average is normally about 3 months. So, um, 25%. It's always been said about 3 to 6 months. And then in this past year, with all of the uncertainty, we've seen a lot of our nonprofits go to 6 to 12 months um, to have that extra cushion to help with cash flow and unexpected costs and economic shifts. And then another question, Richard, that we got, and I'm not sure if this is for you or another one of your William Blair counterparts, but just a general question about how a small nonprofit should start investing, what they should look at.
Yeah, I mean, I'm not, I don't have sort of specific investment advice there, but my view, what I was sort of alluding to earlier, is I think diversification matters more than it has previously. So I think back in that negative correlation period, this slide, that I think the world. My point with this slide is that the world has changed, right? And I think we need to recognize that break in the negative correlation between stocks and bonds. I think it meant that you could have a very passive portfolio, and that passive portfolio ended up getting funneled more and more to the Mag 7. And, you weren't so worried about it because you have that insurance from bonds. And I think the point is that 60/40 portfolio, I think, is now dead. And I think you have to, change it up. I think equities are still very attractive. Equities are attractive in an environment of moderate inflation. Bonds, I think longer term yields probably are a little bit lower than what their kind of fair value would be. So less attractive. And I think what in that sort of negative correlation world, what it meant was, so I don't want to get too technical, but a bond is the sum of expected future short rates. It's an inflation premium and a term premium. So how much duration risk do you see? Do you want compensation for when you invest in a bond? So rather than just buying a 2-year and rolling it over every couple of years to get to 10 years, you can buy a 10-year, but there's a risk involved. So you want compensation for that. It's called the term premium. And the term premium was very weirdly, for the last decade or so, negative. So investors were saying, I don't need a duration risk premium. I can have it negative. And why was that? Is because the correlation was negative. It's like you were paying your car insurance, as I sort of alluded to earlier. But now, if that's positive, if you're no longer getting that car insurance for your portfolio, you're starting to demand a higher term premium. So you want to be paid for the risk of holding a longer term debt than rolling over 2-year treasuries. So what that means is it means that your yield has to be higher. And I think investors right now are questioning how high that yield has to be relative to inflation and your real yield. So long way of saying is I think the situation has changed, and I think it's wise to look at sort of different assets and different sectors of the economy where you were right previously to be very heavily weighted in, say, tech, because that's what did really well. I think if we're sort of transitioning to also to economy where we're going to see more investment taking place in other parts of the economy, maybe some parts of the economy like industrials, financials, those sorts of areas can actually do quite well. One thing we didn't talk about is kind of a potential lever that the Trump administration has pulled in some areas but not in others is in financials. So the banking system is talking about deregulation has been a huge boost to their area. Other areas where it could start to come through, say, could be the housing market, where we haven't seen a lot of deregulation coming through. So, long story, I've kind of rambled on a bit, but I would say generally, this chart is saying to me that you need to be more diversified in your portfolio construction without going into
And
examples.
that makes sense to us because that's been the theme really all year that we've been talking about on our end too, is diversification. And for us, it's diversification with revenue streams, donors. So it makes sense to include that investments as well. So, Richard, I just want to thank you so much for this great conversation today. It was very interesting. Thank you to all of our nonprofit members who joined. I hope that this talk was interesting to you as well. Please feel free to reach out with questions and follow up. We will be sending out a paper and also a recording of this. And again, Richard, just thank you so much. Thank you to William Blair for introducing us to Richard. And to everyone here, I just want to say that we will have several webinars and roundtables planned for 2026, including tax updates, audit readiness, board member training. So just please be sure to follow us. And if there are future topics that you'd like to hear about, please let us know. So thanks again, Richard, and everyone have a great rest of the year and Happy New Year.
Great, exactly. Thank you very much. And I wish you a happy and successful 2026.
Thank
you
you,
so
Heather.
much.
Thank you, Richard.
Bye.